The first session that we are going to be talking about is about non-banks. And I am very happy that we'll be starting with the paper, Where Do Banks End and NBFIs Begin, presented by Nicola Cetorelli from New York Fed. So Nicola, you have 20 minutes.
Thank you, Amit. And we are extremely honored that you decided to put this paper on the program. This is joint work with Viral Acharya and Bruce Tuckman, both from NYU Stern. It is FOMC Policy Week, so my disclaimer is longer than usual, but just as binding. So definitely these are just my own views. Why don't I get started right away? When Viral, Bruce, and I started sharing thoughts and ideas 3-4 years ago about this, what is now actually kind of a research program. We have at least 3 papers already written on this topic. We were motivated by what actually President Lagarde alluded to in her opening remarks this morning, this magnificent growth of non-bank financial institutions that has been observed globally. And related to it, what seems to be at least somewhat of a replacement of non-bank financial intermediaries over traditional intermediaries, banking institutions. And so the research program that the 3 of us have put together is really revolving around this fundamental question. What is really going on in financial intermediation activity? Is it really that non-banks are intermediaries that are displacing banks? Are they actually becoming the dominant source of financial intermediation activity? And so as we were formulating our thoughts, we were confronted with what we consider the standard, the conventional, perhaps interpretation of this phenomenon. One is what we call the parallel view, which is that, okay, so we have banks on the one side, they are actually intermediaries, and then we have this evolving and ever-expanding set of other type of financial institutions, but truly what they do is something else. They are providing very important financial services to an economy, services for investment activity, risk management, trading, and so forth and so on, but they are not necessarily in the business of financial intermediation. So if that's the prevalent view, then if something goes wrong in that segment, we perhaps collectively have the luxury of let that go. No, there is not going to be much in terms of systemic implications. So maybe a possible policy stance is to keep perhaps these activities separate from banking institutions, and everything will be good. Now, in hindsight, not everything really is that good, because I think we have now repeated examples from recent history where, in fact, there has been the need to intervene in this broader, ever-expanding space. And so the more prevalent view is what we call the substitution view, where, in fact, you make the case that these financial institutions are intermediaries. They are, therefore, for whatever reason, maybe they do it better, maybe banks are more constrained, but they are effectively replacing banks as intermediaries. So what's the implication of that? That maybe if they are intermediaries, then they are, to an extent, potential vectors of systemic externalities, and so we should be treated the same way that we normally treat financial intermediaries, a prudential monitoring, prudential regulation, and this has inspired at least some sort of proposal on the table, as the one that I mentioned here in the bullet. Now, there is a little bit of a silver lining if you subscribe to this view, which is that, okay, at least banks are narrowing their scope. They are moving away from the riskiest activities, and maybe that's a good thing for the value of their deposit franchise, and ultimately it's a good thing for taxpayer taxpayer, right? Because the taxpayer ultimately is on the hook in this situation of crisis. We take exception to that point, and I will return on this in a few moments. Of course, we write papers because we want to propose something different, and so we converged on what we call a transformation view. And the question is, transformation of what? What is the transformation about? So I don't have that much time for this presentation. So this is I think my main slide in terms of takeaways. If there is a slide that I would like you to remember, is this one here. So bullet by bullet, this is sort of summarizing our viewpoint. The first point is that banks are not dying. They never die. They are incredibly resilient, and there are fundamental reasons why that is the case. And I will hopefully be convincing about it again in just a few minutes. And so what perhaps we are observing when we observe this growth of the NBFIs, that is actually the result of banks that are changing, transforming really their own business model, their own risk-taking. And so associated to that, much of that NBFI growth that we have been observing in the last 10, 15 years or so is actually there because banks support it, right? There is really an issue of dependence behind it. And so the banks, much of that growth really requires bank support. And so the point, which I think is a deeper point than what this bullet point perhaps suggests, is that you cannot really look at NBFIs and banks as two separate things, right? In a way, we may have clear ideas about organizational boundaries, right? There are these institutions that are, yes, organizationally separate from banking institutions, but in terms of operational boundaries, that boundary is probably much more tenuous, and that's really where our analysis hopefully comes into place. There are implications of that, and the implication is that perhaps there are systemic implications associated with this transformation. It's not as simple as perhaps NBFIs up, banks down, and risks migrating outside of the banking system. In fact, there is a potential for an underestimation of banks' true risk exposures. And as a system, we suggest that, in fact, the propagation and amplification mechanism may have become less clear and also, in terms of scale, larger than what the system was before. Okay, so that's, again, in terms of takeaways. So let me spend 2-3 minutes with really basic points about what justifies our transformation view. There are just two basic elements. The first one is the observation that bank regulation became much tighter post-financial crisis. So banks have indeed been subject to much higher regulatory constraints in terms of engaging in the riskiest activities, and also the requirement to hold larger liquid buffers. So that in and of itself would explain this transition of banks away from certain type of activities, and then to the extent that technology allows and institutional details allow, you may actually see an alternative emerging, right? So this non-bank financial institution. We don't think, however, it's really the end of the story, because nevertheless, banks maintain this natural advantage at being intermediaries. That one has not changed to the best of my understanding. And that natural advantage is really the result that banks have, at least from an ex ante perspective, exclusive access to official backstops. It's liquidity facilities, the guarantee of at least part of their liabilities, and that is what gives banks an edge that simply has not changed over time. It is what makes them able to source stable funding and to have also a special ability to manage liquidity risk. So those are kind of the premises. That's our conjecture. And so I mentioned earlier, so why is it the case that there is maybe this dependence of NBFIs on banks? What justifies our point? Well, there is dependence to the extent that these institutions are, again, engaging in financial intermediation, and meaning that they are engaging in liquidity and maturity transformation, which means that management of liquidity risk is really, it's the bread and butter of what they should be doing. Okay, so they are in this business, so how can they do it effectively? How can they manage this liquidity risk? Again, we have a long history that has taught us that traditionally, the traditional intermediaries, which are the banking institution, have become stable in that business model only after being the recipient of credible support from institutions. And so now you have this new set of institutions, the non-bank financial institutions, that are engaging in intermediation. By, would say, definition, they do not have standard access to liability guarantees. They don't have access to liquidity facilities. How can they be successful? How can they grow as intermediaries? How can they credibly provide intermediation services? They still need to manage liquidity. So how can they do it if they don't have access to the backstops? They can buy these services. And who can provide those services? The banks. The banks, because they are the ones that have access to the backstops. So in a way, the banks are the ones that are passing on to this new set of institutions part of the benefits associated with their institutional role. So some evidence of that. This, what we are suggesting, should also predict a natural increase of banks providing funding to the non-banks, and we certainly see that at least with United States data. I'm hearing that actually this is the same also in Europe. This chart here on the left is showing with very granular data, confidential information just on the banks that are subject to stress testing, that in fact these are loans on the book of banks have grown quite remarkably in the last 10 years or so in the entire rainbow of NBFI segments that you can use to classify this entire ecosystem. What I think is actually more telling is the chart to the right, which is showing NBFI loans as a share of total bank lending. And the fact that it's increasing, and it's been a steady increase, to us corroborates the prior of a shift, the transformation of their activity away from the traditional segment, the real side of the economy, to the support of a new cluster of intermediaries that are then interfacing themselves with the real sector. Now, this is from the perspective of the banks. Is this actually relevant? I haven't really proven to you that NBFIs themselves are dependent on banks. It's very hard to assess that because almost definitionally, good data on non-regulated or less well-regulated institution is hard to achieve. We can look at it at a very aggregate perspective using a new tool of the flow of funds of the United States that had been put together about 3 years ago. I think we are still the only researchers that are using this for research purposes. With this new tool of the flow of funds, for the first time, we can actually see the funding interconnection between banks and NBFIs, all the sectors. So in other words, we can see at every segment as issuers of liabilities, and we can see which segment of the economy is holding those liabilities as their own claim. And so I can focus on banks as the holders of NBFI liabilities, and the data seems to suggest something that corroborates our point. They represent important chunks of NBFI's liabilities. 10% of ABS issuers' liabilities are held by banks, 25% of those the broker-dealers, REITs, and so forth and so on. Interestingly, banks are not as dependent on non-banks. Fundamentally, banks continue to fund themselves in the real sector. That is, again, a reflection of their deposit franchise, which is based on the reason that I mentioned earlier. So I think that is another important piece of evidence. It's not just what sits on the books of the banks. To me, actually, this chart is even more important. It is about providing contingent funding, right? So credit lines to NBFIs. That has grown at an order of magnitude even higher, as you can see on the left. And again, on the right, you can see evidence suggesting the shift of attention, if you will, from the real sector to NBFIs by banks. So I will conclude with what might be the implication of this empirically. As I mentioned at the beginning, the conventional view seems to predict maybe a greater insulation of banks now that NBFIs are taking a larger role in intermediation activity, especially credit intermediation. But our perspective, as you may have guessed already, in fact suggests the opposite, that if anything, the exposure of banks is increasing with respect to the counterfactual, where they were the only game in town. And especially the reason why there is this increasing level of exposure is that credit lines to non-bank financial institutions are especially difficult to price. And in particular, what is very difficult to price is the event, the materialization of states of the world where these credit lines are going to be drawn down all at the same time. And because these are NBFIs, there is a very high likelihood they are all in the same business of providing credit, that in fact there is going to be a high chance of correlated risk. And that component of correlation of risk, the fact that credit lines may be drawn down above and beyond your expectation of individual obligors characteristic, is what we think can seep through and have an impact on banks. And so we should be observing in the data that there should be these systemic risk spillovers. One testable hypothesis that we entertain and we present in this paper is that you should be observing an increase in correlation of the systemic vulnerabilities of banks and NBFI sectors. In other words, both banks and NBFIs should be subject to, their systemic vulnerability should be co-moving, and that co-movement should be increasing over time as a result of this increase in interconnection. And that's exactly what we observe in the data. This chart is showing the correlation in changes in S risk between banks and NBFIs. That correlation is positive and certainly not small, because these are all financial firms pre-GFC. That's the base. But again, post-GFC, that correlation has just went up at very, very high level, and it has remained quite high. Of course, this is not causal evidence. We have another paper where we entertain more rigorous analysis that effectively confirms this point in a clearer place. So my last slide, summarizing with maybe some policy implications. Again, so there is a raising regulatory burden on banks, but that per se does not mean that banks are reducing their exposure. What we are observing is just a change in the nature of the exposure. And the second part of that sentence, may be provocative for this audience, for the discussion. I would suggest that at least part of the observed NBFI growth is really an artifact of regulatory arbitrage. And I'll be curious to see if I receive a lot of pushback on that. And so there is this transformational risk is going to lead to higher levels of risk-taking in the system. And the reason for it is that, again, there is actually increasing amount of intermediation activity that is moving in the hands of institutions that are less subject to prudential standards. And so they may have risk-taking incentives that are in fact larger than the one the banking institution would want to operate under, and that is going to create a lot of problems. Just minus 30 seconds to just suggest policy implication. The obvious one, and this is really the lowest hanging fruit, is the fact that, again, you cannot look at these two segments separately. You literally, it's almost as if you want to have one balance sheet that combines banks and non-banks. There are actually good recent examples in this direction. The Bank of England Suez initiative is one that definitely acknowledges the importance of these connections. Fed board in the very last round of stress testing explicitly focused on NBFI credit line drawdowns of banks. So that's, I think, it's very encouraging. Much less low-hanging fruit is how can you do this? You can perhaps try to regulate this type of risk through the banks. Collateral prepositioning sounded like a good idea until Raghu debackled that in his own remarks earlier, that it's always going to be a problem of time consistency in applying these rules. So we just leave it there, for cocktail conversation maybe. And even the worst one, I mean, this is definitely the highest tall order ex post commitments. In other words, if a segment receives a lender of last resort services, that might be an indication that perhaps those segments should be subject to stricter prudential regulation. Again, easier said than done. I'm not paid enough to actually provide you with the solution for that, so I'll just leave it there on the table. Thank you.
Thank you, Nicola. We have two discussants because competition leads to risk-taking, I guess. The first discussant is Tomasz Piskorski from Columbia University.
So thank you for the invitation to discuss this interesting paper. So what's the broad motivation for the paper? We all know the NBFI sector has grown quite a lot, and now the assets of NBFI sector surpass globally the traditional banking sector. Why are we potentially concerned about that? So the financial regulation has been mainly focused on traditional banks. The assumption is they're at the center of financial intermediation, but as we know, the shadow banking NBFI sector grow quite a lot. We don't exactly monitor it as well. We don't know exactly as well what they are doing. So, a lot of policy discussions are around, bank capital regulation, like Basel III Endgame. The US bank were pushing a lot against that. But then when we think about shadow bank sector, there are obviously the linkages between traditional banks and NBFI. So recently we have issues with a tricolor lender. It's a private credit fund that makes car loans. It's a typical non-bank lender because it actually borrows money from Barclays, JP Morgan. It doesn't have balance sheet capacity. It makes loans, but it subsequently securitizes. It's very dependent on debt securities market, capital markets for its funding of its loans. And this kind of linkages are also raising a lot of questions about financial stability, risk, and so on. So the way that Nicola set it up, we could think about different ways about NBFI sector. One is maybe they just really do something very different from each other. Another, maybe there's a substitution, and NBFIs are just taking the business of traditional banks. And, they coined this term transformation view in the sense that, it's really the interdependence between these two sectors. And in particular, the banks have deposit advantages. They can provide liquidity services and loans to the NBFI sector. And they viewed we have to really analyze them in conjunction and analyze equilibrium interaction between these two sectors. I just want to say that I broadly fully agree with this assessment. We kind of coined similar term, distributive financial intermediation. The idea is that we really need to understand these interlinkages, and they're very important for evolution of these two sectors. So in terms of evidence, I think the paper provides a really nice evidence on the interdependencies between banks and NBFIs, the growth of lending of banks to NBFIs, including also the shadow lending through credit line commitments, the kind of work David and Victoria did a lot of work on. And case studies, an interesting correlation also that suggests the sectors are getting more and more moving together that sort of highlight these interdependencies. So the kind of broad implication, there is this nexus of bank and NBFI. I think it's an uncontroversial statement. We need to look on the entire sector from the regulatory perspective. More controversial things is like what to do about it from the policy standpoint. Some things they advocate a bit implicitly is extending liquidity guarantees to non-bank sector and so on, but obviously we need to think more about that. So in terms of my comments, as I said, I just broadly agree with the view that these sectors involve in conjunction. We need to really analyze them together. So what I want to do a little bit in my remaining time is to shed a little bit more light on the growth of NBFI sector, in particular adding that technology plays a very important role. They focus on the last 2 decades and they talk about regulation, but there's a lot of other things going on. I'll show some additional evidence on risks in NBFI sector and traditional banking sector. And I will conclude with really kind of a need of a new model of financial intermediation. I'll show you some kind of outtakes of what such model might deliver from the policy standpoint. So first, let me show you, go to the US credit market and show you some kind of a big trends. So first, if you look on the lending, in the US in the 1970s, vast majority of loans were originated by banks and financed on bank balance sheets. So I'm showing you the fraction of lending that financed by banks to households and firms. Then it declined to now to only about a third. Note, this decline really happened before great financial crisis, before the regulatory tightening. So there's obviously something else been going on before. Now, of course, the banks also invest in debt securities once you add them, and some of these debt securities are actually issued by NBFI sector. But even with this, you see a significant decline in traditional bank financing to household and firms, which now accounts for less than half of the credit. So what are the underlying reasons behind that? It's really a lot of developments of the modern debt securities markets. Think like CLOs, MBS, ABS, corporate bonds, facilitated by technology, development of computerized system, modern scoring that limits informational asymmetries, as well as regulatory support to that securities market. Think about government-sponsored enterprises creating a liquid market for mortgage-backed securities. So this is on the lending side, but since less lending is financed by bank, who finances it? If you look on the deposit as a share of financial wealth, the deposits become less important. They account for 20% of financial wealth in the 1970s. Now it's just a little bit above 10%. And why? We have developments on the saver side. Shadow money, modern pension funds, money market funds, debt fund ETFs. So essentially what happens is, as a saver, as an investor, I don't need to give money to bank through deposits and then they just invest it into loans. I can just give money to pension funds that buys debt securities that can be originated or created through the NBFI sector. And finally, if you look on the loan share of bank assets, they also decline. In the 1970s, 70% of bank assets were loans. Now it's only about 55%. And here actually regulation plays a role in it. You can see a decline after great financial crisis, the liquidity rules and so on. But also since loans become less special, banks also allocate more and more of their deposit funding towards securities. Now, what about risks? Just a quick reminder, we always worry about NBFIs, but really, at least in the US, the banks are very highly levered. A typical bank is 90% debt funded, 10% equity. Most of the debt funding is deposits, half are uninsured. So banks take a lot of duration and credit risk with a very high leverage. The SFB crisis and show it, the Fed raised rates, bank asset values significantly decline, and there was a ransom dozen of banks before the intervention. So on that metric, if you look on non-bank financial institutions, this is kind of an outtake from our work looking on mortgage lenders, they actually have substantially lower leverage. And there's an emerging amount of work showing this in different lending markets. For example, David has a work looking on business development companies that also show that private credit companies like that are also substantially less levered. So in that sense, the NBFI lenders appear to be less risky. This actually holds if you also control for asset quality. But then, of course, there's an issue of lending and dependence of NBFI on bank loans. Like this is from Erica Jiang job market paper. The banks really are main provider of credit to non-bank mortgage lenders. And a simple calculation with it shows that currently about $1 of non-bank lending is financed with about 8 cents of bank direct lending, plus there is the shadow credit lines. And it has been growing, which is consistent sort of with Nicola view. So what are the regulatory considerations? NBFI is growing, but they're dependent on bank credit. There's something special about deposit funding. And then obviously it raises question like what should be the regulatory perimeter, and ultimately we have to think about what the social objective is and what frictions we try to solve. Are we worried about runs in the NBFI sector? It depends on what type of functions they do and how separate they are. So generally what I just want to say, the strengths of the growth of NBFI is going beyond regulation and global financial crisis, but obviously regulation play a role there. I think technology plays a very important role in it. In particular, we have a new wave of tech coming. Think about stable coins, DeFi, artificial intelligence, so that can erode further deposit advantages of banks. Obviously, from a regulatory standpoint, we have to be looking on these two sectors. It's always difficult because our regulatory agencies are siloed. So, the one focus on deposit insurance, one focus on other things. In Europe, it's even harder because you have different countries talking to each other. But as I say, we really need to think about it in a new way. We need a new financial intermediation framework that kind of structurally recognizes these linkages. It's just not a kind of a cheap bullet points. We've been thinking for several years about that. So in the remainder couple of minutes, let me just show you what such framework might deliver, just to give you the teaser. So the way this is from a recent work with Greg Buchak, Gregor Matfos, and Amit Seru. So the way we think about financial intermediation, we have a saver sector that has money. We have the borrower sector that needs money. In a traditional bank business model, you had a banking sector in between them. Banks get deposits, they allocate them to loans and securities. But now we have this NBFI sector that also can lend to households and firms, that also gets money from the saver sector, but through different means. And there's this interconnectedness between these two sectors in two ways. First, banks also invest in debt securities originated by NBFI sector. Secondly, bank finance NBFI through loans and credit line commitments. And that's we need to kind of and then is of course central bank that also affects this through the reserves, through the quantitative easing policy and interest rate policies. So to really understand modern financial regulation and policy analysis, we really need to understand how the modern financial system works. And in the last minute and a half, let me just give you a teaser what such framework can deliver, and I will just conclude. So imagine, for example, you would raise capital requirements on traditional banks. What will happen in this framework, you will see a significant decline in bank balance sheet lending. So if you just look on call reports, you will see less bank loans in relative terms. But the aggregate credit actually declines only very modestly. So what really happens is when you raise bank capital requirements on bank regulation, you have transmission of credit away, reallocation away from traditional banking sector towards debt securities and NBFI financing. So that suggests the policy trade-off is somewhat different. The regulation doesn't necessarily curtail the overall credit as much. It's more reallocates it away from more regulated to less regulated sector. And of course, affects maybe who also can get credit. So these are kind of first order policy trade-offs. This is the last slide before I conclude. Think about monetary policy. This is based on our modern financial intermediation framework. We can decompose monetary policy into changes in interest rates and quantitative easing the purchases of assets. And generally when interest rates go down, all else equal, you're gonna see more lending in both traditional and NBFI sector. But for example, if you consider quantitative easing policies, asset purchases, they again reallocate credit away from traditional bank balance sheets, direct loans, towards debt securities. Because if the central banks start buying debt securities, the NBFI sector can respond, and banks will respond to this too. So there's this important reallocation effects. So just to conclude, we really need to rethink how we model financial regulation, taking all these linkages together. And ultimately, we really need to seriously, once we understand how the system works and how it responds to various instruments, we have to really think about what is the welfare function we try to solve and how to sort of best address it.
second discussant is David Scharfstein from Harvard Business School.
Thank you, and thank you for the opportunity to comment on this very interesting paper. I think there's going to be a bit of a outbreak of agreement at a research conference, but I'll maybe try to say some things that folks might not agree with. As you know, the basic argument of the paper is to sort of outline these alternative views of the financial sector, and they propose this transformation view in which banks and NBFIs are dependent on each other's, and they sort of make the argument that NBFIs seem to be more dependent on banks than vice versa, and that policy needs to take this dependence into account. My comments are going to focus, I basically agree that this transformation is happening and is ongoing, but I'm going to try to expand on the driving factors. Some of it will pick up on what Tomasz was saying. And then I want to explore the implications for financial stability. And I'm going to do a bunch of this in the context of private credit, which is the NBFI sector that I have been studying. Interesting, this is speculation and maybe consistent with what the authors found in the paper, where it feels like the dependence is more that banks are less dependent on the NBFI sector for their funding versus the other way around. And it is interesting that like salient pre-GFC examples mainly involve in some of the stability risks were bank dependence on NBFIs and the market, right? Money market fund financing of banks, CLO purchases of bank syndicated loans, securitization of private residential mortgages, asset-backed commercial paper with bank liquidity backstops. And some of that really seems to be less than it once was. And the salient post-GFC examples involve NBFI dependence on bank funding, whether it's private credit funds, fintechs getting their credit facilities, private credit funds getting credit facilities from banks, warehouse lines to mortgage originators, and then banks purchasing and insurance purchasing senior tranches of CLOs. So it's an interesting question as to whether that, in fact, has something that's been changed, and it's a little bit hard to measure that, but it would be interesting to explore that. Okay, so I want to talk a little bit about why there's been so much growth in NBFIs and bank funding of NBFIs. And here I think the paper sort of talks about regulation, but I want to take a little bit more granular approach to that. So one explanation is that there's increased capital requirements post-GFC is moving activities to less regulated, more leveraged NBFI sector. Okay, this explanation just fails. And I'm not saying that that's exactly the explanation that they're given, but the NBFI sector is generally much less leveraged than the banking sector, particularly in private credit, even when you do it on a risk-adjusted basis. This is work that I've done with Sergei Chernenko and Robert Iolente, and in non-bank mortgage origination in the paper by Zhang that Tomasz and Amit co-authored as well. So you need, but I would say pre-GFC, that felt like a pretty good story. Like if you look pre-GFC, what you saw was a lot of non-bank financial entities, GE Capital, CIT. These were non-bank financial lenders. They're the sort of private credit funds or private credit entities pre-GFC. They were much more highly leveraged and short-term funded. That is not what we're seeing today. So private credit funds tend to be much less leverage, and they have leverage that's sort of on the order of, just debt to not risk-weight adjusted assets of like 50%. So capital of 50%. So that story doesn't quite work. So I think there's a number of other factors that combine to help explain the growth. And again, this is sort of in the context of private credit, but I think it's broader. So post-GFC capital regulation and supervision has made safe lending relatively more attractive than risky lending. So like if you do the analysis, the implicit risk weight on a leveraged loan is greater than 100%. So leveraged loans is essentially what private credit is. They're making loans to private equity to help do buyouts of private equity sponsored firms, while the risk weight on loans to private credit fund is just 20%. So it's structured in a way that when a bank is making a loan to a private credit fund, it gets a 20% risk weight. And it's treated as a securitization and a senior tranche in that. So there's a really big difference between making a loan to a private credit fund and making a loan to a non-financial borrower. And we kind of go through the economics of this, and the return on equity for that loan looks a lot more attractive. I think a second part of this is that banks have no origination, underwriting, and this is an extreme statement, servicing edge in lending to private equity sponsored firms, which is what private credit's about, to homeowners, to consumers, and to small business owners. It's a combination of technology, and it's the fact that private equity sponsors, they're not, the bank, you think of the bank as having a branch network, being in the community. You don't need to be in the community to make a loan to a private equity sponsored firm. And there may even be a disadvantage given supervisory costs and restrictions. We do some analysis in some of our work where we say, actually, if you look at when banks talk about getting into private credit, it's not on balance sheet, but it's rather off balance sheet through their asset management businesses. And that implies that there is a cost, and they're doing it in a more, in a less leveraged way, with more capital backing it, and with higher funding costs. They're not funding it on balance sheet. Why is that? That has to be saying something about what the supervisory costs and restrictions are. And then the third point, and Tomasz also mentioned this, is the increasing institutional demand for fixed income assets, right? With greater wealth, retirement wealth, and other forms of wealth, there is a lot of demand to actually directly hold assets rather than holding, bank equity. Low-risk lending to NBFIs exploits the edge that banks do have, namely low-cost funding and access to liquidity backstops, and does not require a costly origination platform. So I think those are some of the factors that are driving that growth. So I also want to talk about financial stability implications. And what are the risks associated with bank funding of private credit funds? And so this is work that I've done with Sergei Chernenko, where we do basically stress tests on private credit funds using data on business development companies, which are essentially a type of private credit fund. They give a really good glimpse at the private credit space because they are sponsored by asset management businesses that have private credit funds, and they have these BDCs. They hold pieces of the same loans. As I mentioned before, these BDCs, I shouldn't say, it's not banks, it's BDCs have capital of about 50% of assets, which are not risk weighted. If you do the risk weighting, it's like 30 to 40%. And those stress tests reveal very high stressed capital buffers. Typically, bank loans to private credit funds require that the assets backing those loans exceed 150% of the borrowed amount. This is this notion of an asset coverage ratio. And this over-collateralization is the key to getting favorable capital treatment. So to get that favorable capital treatment, banks protect themselves by over-collateralizing those loans. Now, importantly, what are the stability implications of this? That over-collateralization protects the bank lenders against the losses over the stress scenario. But these loan covenants and regulatory requirements lead private credit funds to deleverage to stay in compliance. So we do a simulation where we say how much deleveraging would there have to be to stay in compliance with these ACR, asset coverage ratio, loan covenants. And what we see is that the BDCs, these private credit funds, are going to use loan repayment proceeds to pay down debt rather than to reinvest. And they may have to sell assets if it's possible. It's not exactly a liquid market. And the extent of deleveraging is going to depend on a variety of factors, including how the BDCs are funded. So I would say like the risks to banks, and this is, maybe a controversial statement here, but the risks to banks are limited, but the deleveraging of the NBFI, the private credit funds, may be more concerning. If you look at during the GFC, banks were protected even as a number of risky BDCs defaulted on loan covenants and significantly deleveraged. So the regulatory apparatus is protecting banks, but potentially exacerbating deleveraging in private credit funds. So let me just conclude briefly with, emphasizing the point that the main risk may be about related to deleveraging. I agree with Nicola's point that credit line drawdowns by private credit funds during stress conditions could limit the ability of banks to lend to others. And that's something that we really do need to think about, that even though banks are protected, the drawdowns could lead to a deleveraging in some sense of the banks themselves. Some questions to think about is, do deleveraging risks of this sort require a policy response? Okay, is deleveraging excessive relative to a plausible benchmark? Would there be less deleveraging if these NBFI loans were instead on bank balance sheets, which are, by the way, much more leveraged? And are there policy responses that could mitigate the problem without exacerbating others? And then finally, these are questions really, I don't have the answer. Should NBFI growth funded by bank lending be a cause of concern or potentially of celebration? In some sense, it de-risks bank balance sheets. It moves credit creation to less leverage entity, maybe less deleveraging, that's the positive. On the other hand, there's obviously been a boom in private credit. One has to take account of that. Is that leading to excessive leverage in the non-financial sector, both households and firms? Is it concerning that the NBFIs might have, again, excessive leverage, not access to lender of last resort facilities? So lots to think about that this paper brings up, and look forward to any discussion that we can have.
Thanks, David. Let's open it up for Q&A, Nicola, if you're okay with it. And maybe while you're answering, you could bring in some of the points that you wanted to address, what the discussants brought up. So as you ask a question, I've been asked to tell you to stand up while asking the questions and speak to the microphone. Any hands?
Hi, Amir Sufi, Chicago. This is just reiterating a point that David was saying, but I would push a little bit on. If you look at the private credit funds, which are the other major source of financing in private credit other than business development companies, the Federal Reserve put out a financial stability report in May 2023. We have access to Form PF on one of the research projects I'm working on. They're remarkably unlevered. And again, it's the Federal Reserve, so if someone's supposed to be watching out for this, it's them. And they basically say the financial stability concerns are minimal with private credit funds because they're using such a little amount of leverage, far less than the business development companies either. So I guess in the context of private credit, there may be a bit of pushback that the parallel view in private credit is kind of the right view, that it does seem like there's a specialization of private credit funds in a particular type of business, private equity sponsored businesses, that really doesn't rely on banks almost at all in any part of the intermediation chain. So I agree, obviously in subprime auto, we know there is some important, but it seems like the most explosive growth in the non-financial business sector does seem to be happening largely independent of banks, or at least a lot less than banks than we may guess otherwise. That's in the US. I don't know what the European experience is. Maybe it's different in Europe.
Yeah. No, thanks for the question. Thanks for bringing the private credit funds in the picture, which is remarkably a recurrent refrain when we have these conversations. So you mentioned that report from 2023. A 2025 report of the Federal Reserve actually now is pointing at, in greater detail, at, again, the exposure of banks through credit lines. And the fact that those have grown a lot, and as well as, in support of the business of the private credit funds. And so it is true that those vehicles have very little financial leverage, as I think Tomasz was mentioning in his remarks, and yet they depend extensively on bank credit lines for their business. And in fact, the fact that they are effectively funded by equity, but they use the credit lines to manage the equity flows, the capital calls, or to avoid potential unscheduled capital calls. And so that credit line that the bank provides to a private credit fund is effectively encouraging the equity investment in these vehicles. So I wouldn't be so, I would be a little bit more, I think it's a little bit more intricate as a story. It's not that they do not have leverage. They still have a lot of reliance on contingent type of funding, right? So if those credit lines are going to be drawn down, that's going to be materializing on their balance sheet. So I think that there is actually an implication there where there is, I don't know if you want to call it hidden leverage or mask leverage, or at least the need to consider that business activity in combination with the provision of these liquidity services by banks. I think that's an important point, which ties me, to the comments that David made. And again, he's right. I think we agree way more than what we disagree. In fact, I would need to nitpick to see in what way we disagree. But I would want to stress the importance. At the end, you were talking about the systemic implications, that maybe the banks are protected. It's just that there may be some sort of fire sale externality due to the deleveraging of these funds. But I want to point out at this risk correlation associated with the drawdown of credit lines of the private credit funds. And again, I don't have strong empirical evidence on it, but let me just use one anecdote that I think we report still in this paper. In March 2020, Blackstone, that is one of the largest private credit funds, actually, when they were facing their own liquidity stress because their clients needed additional funding support, the non-financial clients of Blackstone instructed their clients to draw down on their own bank credit lines, at the same time that they were presumably also tapping on their own credit lines. So that's the scenario of risk correlation that we have in mind when we are sort of suggesting that there may be systemic spillovers larger than what, again, might be observable on the surface, and so that actually banks may be not as protected.
Thank you. Oreste Tristani, ECB. No, I was just wondering, you emphasized a lot the financial stability implications, but also tying this up to the keynote speaker. I was wondering whether you have any views on the specific implications of your transformation view for the transmission of monetary policy. So the first discussant also alluded to this. That's
part of our research program and the research program of many other people, I think, in this room. I mean, monetary policy in such a more intricate financial ecosystem, I think really requires revisiting all the transmission mechanisms. We have in mind the traditional lending channel monetary policy through the balance sheet of the banks, but in a world where banks are shifting their funding liquidity provision away from where monetary policy would want to actually have an impact and toward this new, sort of intermediate link of the intermediation chain, I think requires investigation, right? Because I don't know really what is the sensitivity of lending of banks to non-banks as a result of changes in monetary policy, because that is going to be another channel of transmission of monetary policy eventually to the real sector in ways that definitely is much more complex than in a simple setting as the one that Tomasz was showing at the end, right? Savers, investors, and simple intermediary in between. So I don't have an answer, Oreste, sorry.
Enrico Barotti, University of Amsterdam. So I am convinced that private credit and private equity firms running this operation are very, very broadly equity funded, but this is a thin layer between the real sector firms to which they're lending and the rest of the financial system. I mean, what is happening in private equity, in private credit, and private equity is a lot of capital extraction from non-financial company. It's a lot of leveraging, it's a different business model, long-term term loans from private credit, substituting what used to be equity. And of course, close management, supervision over management to control the risk. But ultimately, we have levered up a subset, a growing number of non-financial firms to a very high degree, with very competent, I'm sure, oversight by private equity and private credit, which are very linked and operating in conjunction. So I think the fact that there is some equity in between the one holding this company doesn't entirely reassure me that if the crisis were to come from the real sector, it wouldn't be really very difficult for these intermediaries to carry beyond to carry the losses at the underlying firm. So we can think of the shock as being financial, in which case, indeed, is what David says. It would be liquidity problem in selling these stakes. But it could truly be that these firms are extraordinary leverage. This is the Jensen idea of substituting debt for equity and squeezing everything out of it and paying it out. Well, it's been paid out, and there are a lot of firms now that are held, but is under leverage, thin layer, and ultimately, as the sort of companies that the sort of trust company that were holding supposedly safe asset in the financial boom had huge credit lines with banks. Banks claimed these were sort of bankruptcy remote, but when the trouble came, of course, the credit line became equity in failing constructions. Thank you.
Very quickly, I agree, I think, with a lot of what you said. We may have to cite you in the paper. Now, one thing that I wanted to mention, which is about, again, still on private credit related to Amir's question before, it's interesting, in another event a few months ago, sponsored by ECB and Hoover, when there was a panel actually also had private credit fund managers. I thought one, to me at least, very insightful remark by one of the largest private credit fund manager was that, yes, we would not, I think you were there, we would not be able to operate without the support of the banks. Or, I don't know if that was exactly the language. Unfortunately, I don't think it was recorded. But I thought that was actually quite insightful. And again, I don't want to take it as a corroboration of our prior. I think it really speaks to the point that Enrico is mentioning is that it's maybe a little bit more complicated than what it seems.
One last question. Jeet Kapadia from the ECB. So thanks, really great talk. So you focused a lot on sort of the bank versus NBFI split, but I just wondered if you could comment also on just the types of financing. So you could also think of like a loan financing versus a market-based financing type split. And at least in Europe, loan financing is the vast majority of loan financing is financed by banks, whereas debt security financing, market-based financing, and the Discussant also picked up on this, is much more mixed and much more financed by non-banks. And I wondered, in the context of that type of split, at least in Europe, whether it's more a substitution effect, because there's been a lot more of issuance of debt securities as post-GFC, the types of corporate issuance, sovereign bond issuance, and so on. And is that more of a substitution type story if you think about the types of financing, which is a bit different from the institutional bank versus NBFI type thing, but it's obviously closely related because of the NBFI role in debt securities and banks' role in loans, certainly in Europe?
No, thank you. We would be definitely on the wrong side of this conversation if we were saying everything that is happening is driven by this transformation. We try to hedge in the paper. Maybe we have to hedge a little bit more. Of course, we need to also acknowledge that there are other drivers that explain this co-evolution, these dynamics of NBFIs and banks. The development of capital markets is certainly central to that. I think again, if I can sort of point the attention to our research, given my role here today, is that I think we would encourage a closer scrutiny on exactly what drives those developments, including the development of market-based finances. I think at some point we were talking about the explosive role of pension funds as another vehicle that for sure itself can fund non-bank institution, but it's a little bit of okay. Let's trace back all the way to the primitives, to the fundamental drivers, and again, I am still in the camp of really pointing the attention to this asymmetry that modern societies operate under, which is to grant specific rights to a specific type of institution, the banks. And with that comes, I think, a lot that drives dynamics of the entire financial infrastructure, right? So even if you want to model modern financial intermediation, I think you need to have as an ingredient this important asymmetry. So that opens up the question, David, I think, had a bullet point in the end. Maybe we should, I don't know if that's what your intention, we should be providing backstops also to the NBFIs. I think it's the topic of maybe the next paper. And I think that's, yeah, sure, that's an open question, but very, very provocatively, I would say that is probably what would kill banks once and for all, which may be perfectly fine, right? So if you are going to eliminate that sort of special role that banks have in a system, I think that will do it. But then again, collectively, we will have to engage and understand how to take care of, of these systemic risks. Now you would actually have a new set of institutions that really are involved in financial intermediation activity without any sort of, at least private sources of support that the banks previously would have. And then you have to we need to have an adult conversation that is, at the end of the day, bank-like activity that needs to be subject to prudential standards, which means that if you're doing that activity, probably you need to have the name bank, on the door outside. So, we come back, I'm sorry, I think we're always coming back to the same, fundamental core.
All right, thanks, Nicola. Thanks, Tomasz. Thanks, David, for the session. There are more questions, I'm sure. We can do that over lunch. And with that, I need to close the session.